Let me ask you something. If I told you there was a way, a legal, accessible, well-documented way that ordinary people have used for decades to build serious long-term wealth, would you want to know about it? Not a get-quick scam, not a hot stock tip from someone on the internet, something boring, something systematic, something that the wealthiest institution on the planet use every single day. It's called ETF. And I promise you, by the end of this video, you are going to understand it completely. Not just what it stands for, but why it matters, how it works, and why millions of people around the world consider it one of the most powerful financial tools ever created. Stay with me. Before we go any further, I need to be crystal clear. This is an educational video only. Nothing I say here is financial advice. I'm not a financial advisor. Every financial decision you make should be made in consultation with a qualified professional who understands your professional situation. We are here together to learn. That's it. Alright, let's get into it. Let's start with a problem most people don't even realize they have. Imagine you want to invest your money. You've been saving, you work hard. So you heard over and over that investing is how your money works for you. So you'll think, okay, I'll buy some stocks. But then reality hits. Do you buy Apple, Tesla, Amazon, or a pharmaceutical company, an energy company, or a bank? There are thousands of public traded companies in the world. And here's the brutal truth. Most professional fund managers, people who do this full time with teams of analysts and billions of dollars, fail to beat the market consistently over time. Let that sink in. If the professionals can pick the winners, what chances do the rest of us have? This is the problem that ETFs were essentially designed to solve. So let's start explaining the ETFs. ETF stands for Exchange Traded Fund. Now let's break that down because each word actually matters. Exchange traded means it trades on a stock exchange. Just like you buy a share in Apple or Google, you can buy a share of an ETF throughout a regular brokerage account. It's bought and sold throughout the trading day, same as the shares do. Fund means it's a collection, a basket of assets. It's not one company, it's many. So an ETF is essentially a single investment vehicle that holds a collection of assets, stocks, bonds, commodities, or a mix of it. And you can buy all into it with one single purchase. So different to shares where you buy directly the company. Think of it like that. Imagine you walk into a fruit market and you want a variety of fruit. So you walk around the market to the entire market, buying one apple from one stall, buying oranges from the other one, or a handful of grapes from another one, paying a different price. So making different decisions at every single stall. Or you could go into the market, pick up a pre-made fruit basket that already contains all of the fruits that you are searching for. A selection of fruits at a fraction of the effort and often a fraction of the cost. So do you want to walk around to the market or do you want to pick the fruits just as a basket? That fruit basket is your ETF. One purchase. Instant diversification. Done. Okay. So now we know what an ETF is. Now let's talk about how they actually function behind the scenes because this is where it gets fascinating. Most ETFs are built to track an index. An index is basically a list, a snapshot of the market. Most famous one, of course, the S&P 500, which trades the largest 500 public listed companies in the United States. When you hear people say the market went up today, they're often talking about the S&P 500. So an ETF that tracks the S&P 500 simply tries to mirror the performance of that index. If the index goes up by 10%, the ETFs goes up roughly 10%. If it drops, so does the ETF. There are no stock pickers, no expensive analysis, just the market as it is. This is known as passive investing, and it's at the core of why ETFs have become so popular. Now, here's the clever mechanism part. Large financial institutions called authorized participants work with ETFs providers to create and redeem shares. They buy the underlying assets, let's say all of the stocks in the S&P 500, bundle them together and exchange that bundle for ETF shares. They can also do the reverse. This creation and redemption mechanism is what keeps the ETF's price closely aligned with the actual value of its underlying assets. It's an elegant system, and it's why ETFs typically traded very close to what they are actually worth. And because they are traded on an exchange, as you, an investor, can buy or sell your ETF shares at any point during the market hours, unlike traditional mutual funds, which only price once at the end of each day. Now, not all ETFs are the same, and this is important to understand because the variety is actually one of the things that makes them so powerful. Let me walk you through the main types. First, stock ETFs. These track a collection of stocks. Could be broad like the entire US market, could be narrow like just technology companies or healthcare or renewable energy. This is the most common type. Second, bond ETFs. This holds bond, essentially debt issued by government or corporations. They are generally considered lower risk than the stock ETFs, and they have often used to be added as a portfolio stability. Third, commodity ETFs. These track physical commodities like gold, silver, oil. If you believe gold is going to rise, but you don't want to physically store bars of gold in your house, a gold ETF lets you get exposure without the inconvenience. Fourth, the thematic ETFs. If you want to invest in the future of artificial intelligence or electric vehicles or cybersecurities, there are ETFs built around almost every theme that you can think of. Fifth, international ETFs. This gives you exposure to the markets outside your home country, European markets, emergency markets, Asia, and so on. The world is your basket of fruit. The point is, ETFs let you tailor your exposure to virtually any area of the market in a single low fraction trade. Now, let's talk about the cost of an ETF. This is one of the most underrated advantages of the ETFs, and honestly, one of the reasons the financial world was insecure when they became popular. Every investment fund charges a fee. It's called the expense ratio, and it's expressed as a percentage of your investment per year. Actively managed funds, where a team of analysts is constantly researching and trading, can charge 1%, 1.5, or even 2% per year. That might not sound like much, but over 20 or 30 years, the compounding effect of those fees can eat a massive portion of your returns. ETFs, especially passive index ETFs, often charge a teeny fraction of it. We are talking around 0.03% to 0.20%, some even lower. That difference in cost compounded over decades can make a huge difference to your portfolio, although it seems very low at present. This is not a small thing, it's actually a big thing wrapped as a small number. So let me summarize why ETFs have genuinely changed how ordinary people think about investing. Diversification. With one purchase, you can own a piece of hundreds, sometimes thousands of companies. If one fails, the other carry on. Your risk is spreaded. Accessibility. You don't need a fortune to start. Many ETFs can be purchased for the price of a single share, sometimes as low as the few euros or dollars you would pay for the share. So it doesn't mean if the S&P 500 index contains 500 shares that the price of one ETF is the price of these 500 shares. Transparency. Unlike some funds that operate like a black box, most ETFs publish their holdings daily. You know exactly what you own. Flexibility. You can buy and sell during the market hours. You're not locked in. Low cost. As we covered, the fees are typically a fraction of actively managed alternatives. ETFs democratize investing. That's not an exaggeration. They took tools that were once reserved for the wealthy, diversification, market access, low-cost exposure, and made them available to everyone with a brokerage account and a small amount of money to invest. Here is what I want you to live with. The financial world can feel intimidating. It's full of jargon, noise, and complexity, often by design. There are entire industries built on the idea that you need someone else to manage your money, that is too complicated for you to understand. ETFs are a direct challenge to that narrative. They say, you don't need to be a genius. You don't need to be pick winners. You don't need to pay someone a fortune to guess right on your behalf. You can simply invest in the broad growth of economies systematically over time and let the compound do what compound does. Now, that doesn't mean that the ETFs are risk-free. Absolutely not. Markets go up, markets go down. Investing always carries risk, and you should never invest money you can afford to lose. But for many people, understanding what ETFs are and how they work is generally the first step towards taking their financial education seriously. And financial education, that's something no one can take from you. This was an educational video. Everything here is a starting point, not a destination. Do your research, talk to professionals, keep learning. If this video added value to your life, smash that subscribe button, leave a comment below telling me what topic you want me to break down next time, and share this video with someone who needs to hear it. I'll see you in the next one.